An average American household has over $100,000 in debt, and 70% of that amount is a mortgage. When drowning in debt, people usually take one of the two approaches: do everything in their power to pay it off as fast as possible, especially when it comes to a mortgage, or give up and file for bankruptcy, like almost 400,000 Americans did. But neither of these is the best choice. So in today's episode, we're going to talk about how you can manage your debt effectively and why rushing to pay off your mortgage is a wrong strategy. Meet Alan. He's a 35-year-old average American with a college degree. He lives in Kansas and has an annual income of about $60,000. This is slightly below the state average, but Alan is enthusiastic about getting a promotion in the upcoming year. Alan is an ordinary person. He could be your neighbor, your college mate, or just a random guy you meet at your local grocery store. In fact, he could even be you. Alan is a true American. So, of course, he has a traditional American dream: a beautiful home and a family. He's still single, but he has already managed to bring the first part of his plan to life. Alan recently got a 30-year mortgage. He bought a house for $219,000 in Kansas, which is almost 49% below the national average. Looks like a good deal, right? Alan got an interest rate of 7%, so he will have to pay $1,375 monthly for the next 30 years. The interest rate is higher than expected, but the dream is worth it, isn't it? By the way, if you want to learn about why we're paying high interest rates today, here's a video that you can check out after you're done with this one. But back to Alan. He's living in his new home and everything is going well. But he has almost $37,000 in annual debt. How could a 35-year-old have such a high debt? Well, let's look at Alan's debt structure to understand his situation better. So he read this Forbes article and decided to use the 2836 model. This means that his mortgage payments, which is $1,375 in this case, should not exceed 28% of his income. The other 36% is the rest of his debts and should be no more than $1,064. These are credit card debts, car loans, and so on. So how much of this other debt people usually have? When Americans were asked about their most significant non-mortgage debt, the answers were the following. 28% admitted it was credit card debt. 12% said it was car-related debt. 7% had medical debt as the major one. 6% went to home equity loans. 5% had student loans. 3% took the most debt to care for loved ones. And 3% had educational expenses for children as their number one debt source, excluding mortgage. What about the others? The rest, meaning over 30%, said they do not have any debts at all. But most Americans live like Alan, overwhelmed with debt. If we add his mortgage and other loans, that leaves him with about 36% in income to live on. Alan doesn't have a degree in economics, but you don't need one to see that prices are rising. That's what inflation is. Yet, the paychecks don't go up as much. It is a universal tendency for every American. So looking at prices and his debt, Alan begins to panic. He has a fear of never ever paying his debt off. And maybe he won't even be able to afford his mortgage anymore. The best thing that comes to his mind is to cut his expenses as much as possible and pay off the mortgage ASAP. But is this a good solution? Let's find out together. Here are 5 tips that can help Alan and everyone manage their debt effectively. So, tip number 1, do not try to pay off your mortgage ASAP. This point might sound confusing. After all, it seems logical that the sooner you pay, the sooner you are free, right? But it isn't that simple in reality. So let's say Alan decides to pay off his mortgage early. Therefore, he needs to either increase his income or reduce his expenses. That's it. 2 options only. In the first case, he will likely have to take a second job, but to earn enough, he must work 2 jobs for another 10 or 15 years. And guess what? It's too exhausting. Plus, overworking can lead to health issues, and healthcare in the US is anything but cheap. So it's probably not worth it. The second option for Alan will be to cut back his expenses. The mortgage already eats up up to 30% of his paycheck monthly. So he will have to give up many things. It means no traveling, no going out, and no home renovation. So in the end, this is not a good solution either. Sure, either of the two options might help Alan pay off his mortgage 15 years earlier. But instead of a big win, he might face new troubles, like mortgage prepayment penalties. Yes, you heard it right. If you pay off your mortgage earlier, sometimes your bank will charge you a penalty. Why? Because prepayment leaves your creditor with less money. Every year, you pay an interest on your mortgage, and that's how banks make money. But if you pay it off faster than agreed, you get penalized. If you pay your mortgage off in the first 2 years, you can get a fine of up to 2% of the loan amount, or 1% in the third year. And after that, you might be charged a flat fee or $2,000, for example. Still, there's good news. The prepayment mortgage penalty is becoming more and more rare. But the troubles might not end there. Your credit history can also suffer. A healthy combination of credit types is one of the factors that influence your credit score. For example, Alan has a credit card, a car loan, and a mortgage. If he has trouble with one of his loans, his credit score will go down. It will be a fairly small decrease, but it's worth considering anyways. Okay, but what can Alan and you do instead of paying the mortgage too early? This brings us to the second tip on how to manage your debt and mortgage efficiently. And the second tip is make payments on time. Whether it's a credit card or a mortgage payment, don't delay it. Timely payment is one of the best ways to manage any credit, and there are several reasons for that. Timely payments allow you to maintain a good relationship with your lender, reduce the risk of penalties for not paying on time, and improve your credit score. If you are delaying payments, ask yourself why. Are your expenses out of control? Or is your lifestyle unaffordable? Or do you simply forget to make your payments on time? If it's the last point, just set up an automatic transaction from your bank account. It's that simple. But if the issue is deeper, sit down and think about what you can do. Improve your overall qualifications to earn more, avoid emotional spending, or simply track your budget. We'll talk more on that later. If Alan thought of all these things, he might have taken a different decision instead of paying off his house too early. You know, slow and steady wins the race. That's the best approach to managing your debt. Tip number 3, build an emergency fund. Did you know that 60% of Americans don't have emergency funds? Only 19% have increased their account balances since the beginning of the year. If you don't have a safety cushion, you can be more stressed and make poor decisions. For example, Alan has no emergency fund, so he often gets cold feet. Life emergencies often hit us financially. It could be anything, from fixing a car to helping a sick relative. We don't know when and where, but we know that it could happen. Remember Murphy's Law? Anything that can go wrong will go wrong. So having an emergency fund can reduce a lot of fear and confusion. But what's the best way to create an emergency fund? One way to do it is to set aside 10% of your income every month. For example, Alan earns almost $5,000 monthly, and if he saves $500 from each salary, he will add $6,000 to his emergency fund every year. And this is much better than having nothing. What else can help you manage your debt? Create a budget and track your spending. That's our fourth tip. When you move into a new house, you might be tempted to renovate it immediately. You want to buy furniture and all sorts of accessories and decorations, purchase a dining table, comfy chairs, and of course, a new set of dishes.
How could you not buy that? In a new home, everything has to be new.
Well, it is a very slippery slope. If you look at your expenses with the eye of a stranger, most of them are not vital. And I'm not even talking about tightening your belt and saving money. It's about managing your finances properly. The best way to do that is by setting a budget and keeping records of your expenses. Let's take a look at Alan's expenses. Like many Americans, he can spend up to $6,000 a month, often on buying unnecessary things. Because Alan has no spending plan, he often exceeds his budget, increasing his credit card debt. That's why creating an emergency fund is a complicated task for him. If you're like Alan, you need to always track your debt and keep it healthy. What does a healthy debt mean? Start by maintaining a good debt-to-income ratio. To find it, you can use any online calculator or do it yourself because it's fairly easy. You only need to add up all of your monthly debt payments and divide them by your gross monthly income. Then you multiply your result by 100. And there you go. The percentage you get is your debt-to-income ratio. Now, how do you know if your result is good or if you need to work on it? If it's less than 30%, banks consider it to be excellent. This means that you're managing your expenses properly and that, in theory, you can pay your debts on time. If your debt-to-income ratio is higher than 36%, you need to adjust your expenses and start paying off existing loans more actively. After all, it's quite challenging to get a new loan with a ratio like this, or the interest rate will be sky high. But if your debt-to-income ratio is 64% or more, like in Alan's case, you can forget about any credit until you improve this indicator. Next tip to help you manage your debt: review your mortgage statements. What does it mean? When you receive your mortgage statements, be sure to check them carefully. Even if you set up an automatic payment for your mortgage, it is still worth checking. Why? A mortgage statement might contain important updates or changes to the loan terms. This could be an adjustment of the interest rate or a change in your payment terms. And that's important. No one likes surprises. Plus, by reviewing your statement regularly, you can spot signs of fraud or identity theft. So, these were the 5 tips that can help you manage your mortgage and make your whole life so much easier. If you want even more tips on how you can reduce your debt, make sure to check this episode. I'll see you in the next video. Bye-bye.